Hi, I'm John Huang, and you're watching the Junior Investors Club. Quick disclaimer, I'm not a licensed professional, so I'm teaching theory in all my lessons. Therefore, any stock references will be only for educational or teaching purposes only. Most importantly, please portfolio size and do your own due diligence. Thank you. So, first things first, what even are options, right? Options are basically contracts that allow the owner of the contract to either buy or sell stocks, right? These the stocks, right, typically run in what we call lots of 100, right? So every option contract typically controls one lot of about 100 stocks. So the thing about option contracts is that anybody can be an option contract writer, okay? So as long as you have the stocks on hand or the cash on hand, right, you can actually write either options, right, that allow you to buy or sell stocks. So in the options market, there are two types of option contracts, right? One of them is called a call contract, right? And a call contract gives you the right to buy, right? The right to buy, right? Basically, what it means is that whoever holds a call contract, right? Whoever has bought or purchased a call contract and is holding it in their possession, right? Anytime they can activate this contract, or we call it exercise, right? Anytime they can exercise the contract and exercise their right to buy the stocks, right? So remember this. When you have a call contract, when you buy a call contract, you have the right to buy 100 stocks from the market. Okay? Now, the second option contract that you can write is actually called a put contract, right? And a put contract gives the holder or the owner of the put contract the right to sell. Okay, so what that means is that whoever holds this contract is allowed the right to sell 100 of their stocks back to the market at whatever price it was written on in the contract initially, right? So it may sound a bit complicated now, but in a later video, I'll get into how to actually trade these contracts, right? But before we even get into that, you guys need to learn how to even read these contracts because they write it in a very technical manner, right? So let's move on to, let me show you how to read these contracts. So typically when you open up your trading program, whichever platform you choose to trade on, right? You will see option contracts that kind of look like this, right? It's written in a very technical manner, right? Something like this, and this is just an example, right? +1 AAPL 119 Jan 24 150 call at 27. So what on earth does all this mean, right? So let me break it down for you, right? The first part we need to take note of is this +1 AAPL, right? So like I mentioned before, in the stock market, this option contract controls a stock, right? And the stock typically belongs to a company, right? And in the stock market, they typically write the company in short form. They use this thing called ticker symbols, right? So that's what AAPL is. AAPL is a ticker symbol for Apple, right? And then the +1, right? That's very important. The +1 means that you have actually bought this contract, right? This initial first part can either be positive or negative. So it can be a +1 or +2, right? Or a -1 or -2, right? Plus means that you bought it. Minus means that you actually sold the contract, right? So in the options market, you can actually buy or sell the rights to buy or the right to sell contracts. And we'll get a little bit into that in a later video, right? But understand how to read these contracts for now, right? So the second part we need to take note of is this 19 Jan 24. This is actually the date of expiry. All options contracts have an expiry date that you get to decide when you choose to purchase one, right? When you choose to write a contract, you can actually decide on an expiry date. And this expiry date is quite important because this means that you have the right to buy the stock all the way from now, right, until the 19th of January 2024, right? All option contracts have an expiry date, and once it has expired, you no longer have the right, and the option is now worthless because you didn't use it. So it has expired and is now considered, after that, right, on the 20th of January, it's considered useless or worthless, okay? And so you can't use it anymore. You can't use it to buy the stock anymore, right? Now, the next part is this 150 call. And this indicates at what price you control the share at, right? So currently, Apple is around 149. So usually they run in round numbers, right? Or in 50 cents, this kind of thing depends on the option contracts, right? Or depends on the size of the company, right? So in this instance, 150 is the price of Apple that you are controlling it at, okay? And the second part, of course, is the word call, right? Like we mentioned before, there are two different types of option contracts. One is a put, one is a call, right? So in this instance, it's a call, which means I have the right to buy Apple at $150, right? All the way until 19th of January 2024, right? The right to buy Apple at $150, latest by 19 January 2024, okay? And finally, the last part, at 27 and 100, all the way in the front there, right? At 27 and 100. So like I mentioned before, each option contract typically controls 100 stocks or 100 shares, right? So this 100 means 100 shares, right? At $27 is the price you pay per share, right? Option contracts are typically cheaper than purchasing the stocks outright, right? This is what we call leverage. So instead of $150, right? Let's say you are going to buy Apple stock, right? You can either buy 100 stocks at $150 per stock per share, right? Because the current price is 150, or you can purchase an option contract to control the right to buy it at $150 for $27 per share, right? So what that means is that by putting down $27 today, you actually can purchase Apple at $150 all the way until 19th of January 2024. So we have 2 years from the time of this recording, right? And what that means is that if by, at the end of 2 years, let's just say it's the 18th of January 2024, and Apple has become a $500 company, right? $500 per share, right? Initially, on the day we bought it, we bought the right to buy it at $150 for $27 per share. So we pay the money, right? And at the end of it, right, by 18th of January 2024, and Apple becomes a $500 company, we can actually exercise this contract to purchase it at $150 rather than $500 at the market price, right? So this is typically how options work. This is a basic call option, is what we call it. We call it buying a call option. And that's how it works. And that's where the value of it is. But yeah, this is just a quick introduction on how to read the option and just what all these little numbers and alphabets mean, right? And in the next video, I'll go a bit more in depth about how to buy and sell, call and put contracts, as well as all the criterias and all the little pitfalls you need to look out for, right? And with that said, I hope you found this video useful. And please like and subscribe if you want to get notified and updated on the next basic videos, right? And if you found this useful, or you know someone who wants to learn more about this, please feel free to share this with them. I also have a community, www.juniorinvestors.club. The links will be down below, so you can feel free to check it out if you want as well, right? So yeah, I'll see you guys in the next video. Hope you guys learn a bit of something, right? And I'll see you next time. Bye.